And it's time now for Retirement Ready, brought to you by Fidelity Investments. Today, we're joined by Robert Wyrick. He's the CIO of Post Oak Private Wealth Advisors. And Robert, let's talk a little bit about how retirees or prospective retirees might be feeling at this point in the process. We're about, the NBER says we're 4 months into the recession. The market correction has really been about a 3-month process here. And I think attitudes may have changed a bit over the last couple of months, but certainly there's a lot of skittishness, I would imagine, among folks you're in touch with thinking about their prospects for retirement. What would you say is the sentiment of the people that you're in touch with right now?
No, I think you said it perfectly. I think they're skittish. You know, a lot of the boomers that are approaching retirement have gone through 2000, 2008. Now they saw this correction early this year, and I guess the normal correction takes about 3 years. And so we saw this thing come back so quickly, and I think just trepidatious. You know, people that are looking to retire have, you know, what I refer to as sequence risk of, you know, understanding that they need to withdraw a certain amount of money. And if that money draws down too much because of market corrections, then it's pretty taxing on the portfolio.
Well, so we've got an interesting date coming up, June 30th. That's a mid-year rebalance for a lot of people. Some people do it once a year. Others might do it every 6 months. But, people looked at their statements March 31st, and I think we're probably very scared by things they saw. Now, it's going to be a very different picture come June 30th. Do you suspect that maybe attitudes will change when people who aren't plugged into the market on a day-to-day basis realize that financial assets, at least, have turned around a bit? And do you suspect that some conversations you might have had in the spring will have a different tenor come July and August?
Yeah, I think so. It's interesting now. I believe a lot of people are more dialed into the market now than they ever have been because of the headlines and trying to track the coronavirus and what it means for their portfolios. I think a typical asset allocation portfolio for a retiree or someone approaching retirement of, say, a 60-40 has rebounded relatively nicely, but we utilize protective hedges, and so we understand that our clients have a limited amount of risk going into the market. And I think a typical asset allocation strategy is generally let investors down historically, in that the asset classes that were meant to correlate negatively to one another tend to all correlate at the same time, especially in a downturn. And so I think investors are looking, especially those approaching retirement, are looking for ways to stay protected, but stay invested. They understand the need to sort of keep pace with inflation as low as it may be, but they understand the need to stay involved.
Well, and so you mentioned, let's talk maybe folks that are inside of 15 years before when they think they'll retire. You'd typically start to see that fixed income allocation come up quite a bit over those years. Is that still something that you think can work in this environment? I mean, what do you do when you're getting, 65 basis points on a 10-year? I mean, fixed income has really, on the income side, doesn't really do much for folks anymore. How are you thinking about, folks that are kind of getting towards that date, want to be more conservative, but again, they're basically getting cash if they're going to go to more treasuries, things like that?
Yeah, no question. And of course, there's a conversation about potential for negative interest rates, which I don't know if it'll happen, but yeah, I mean, fixed income is a tough proposition right now, and again, if you look at sort of the trough of the downturn, a 60-40 portfolio was still down 20+%. It's a lot of risk, and more risk perhaps than a lot of people are willing to take. Again, in our cases, we don't use any fixed income. And so we typically have a fully invested equity portfolio with 5 or 6% allocated to a protective hedge. And so that we can participate, utilize dividends to generate the income that we need and look more for total return. In 2008, I guess fixed income did a pretty good job of protecting, even though a 60-40-ish type portfolio was still down 20+%. That was sort of in the midst of one of the biggest bull markets for bonds in U.S. history, and so I don't know that those metrics hold up in this climate.
And then maybe, we'll just finish with some younger folks you might be in touch with. I think people, look at, people in my generation, we look at, saving for retirement. I guess we'll just hope and a prayer, but everything seems to be negative. For maybe some younger folks you're in touch with, even folks that are in their 30s or their 40s, how are they thinking about this environment? Because not only have they, like older retirees, now seen 2 crises in 10 years, but it's oftentimes affected their job prospects. And I think overall, economic security and belief in sort of where everything is headed. And I think that changes all kinds of behaviors and default assumptions all the way down the chain.
Right, right. No, I believe certain segments of the society that you mentioned are actually more disenchanted with sort of the system, if you will, as much as they are the markets. But my experience has been a lot of these folks are actually doing a really good job investing. They follow sort of the Peter Lynch principle of looking around, understanding where it is they're spending money, where their colleagues and friends are spending their money, and chasing the market that way. Maybe they're buying Apple and Amazon and you guys mentioned Spotify earlier. They tend to invest in my experience, in things that they understand, which is probably a good avenue to go for younger investors.
All right, Robert Wyrick with Post Oak Private Wealth Advisors. Appreciate the time. We'll talk to you soon.
Thank you so much.